Hey, what's going on, everybody? It is Monday, April 18th, tax day. Did you file your taxes? All right. Well, we had a nice little rebound in the market near the end of the day. It was kind of wavering back and forth the whole day, and then it was down near the close, and then right near the close, it came back. I think the market is trying to find a bottom in here. Folks, I think I'm the only one who's bullish out there, to be honest with you. I mean, if you read the commentary, if you read the headlines, it is so gloomy and it is so negative. Like really, really negative. Like I've been doing this, I've been in the markets for a long time, and like now when you hear some of these comments, like there's no comparison. It's like aliens coming down from outer space ready to destroy the world. I mean, this is the perfect storm of doom and gloom if you read all this stuff. I just follow my numbers. Look, first of all, let's do a rundown. Fiscal is very strong. We're trending to about a 620 billion month for April. That would make 3 months in a row over 600 billion. That is strong. I told you, you got to go back to last year, May, June, July to see numbers like that. And these numbers, 600 billion plus, that's over a 50% increase from the pre-pandemic fiscal that we had, that was excellent for the economy and for the stock market. Now I understand we're dealing with inflation. We're dealing with very high inflation, and that is a subtraction of GDP. And so we've had, the market stumbled and it's come down from its highs, and it's reflecting, I think it's reflecting the inflation rate right now. And we're going to see Fed rate hikes. All right, everybody is very up in arms about that, and they're hysterical about that. But look, right now, in spite of everything, in spite of this inflation, which is, they say, at a 40-year high, the 10-year Treasury yield is at what, 2.83, 2.85? I mean, in the last Fed hike cycle, which peaked in November 2018, the 10-year was at 322. So we've seen these rates before, at least in Treasury yields, and it's not something historically, if you look for any kind of perspective on this, it's not something historically very high. The markets are pricing in, if you use that, CME has a tool, the Fed Watch tool, that's what it's called. You go Google that, you go to the CME, it'll show you what the market, based on where the market is trading for Fed fund futures, where the policy rate is expected to be, and it goes all the way out. Right now you can go all the way out to July 2023. All right. So what's that, like 15 months out? It's pricing in at 325 policy rate by July 2023. And that, has a lot of, there's a lot of leeway in that, of course, because it's 15 months out. But even at that rate, that's the rate that we have already had in November 2018. I get back to the fiscal, which is very strong. Let's talk about the banking data. That's also very strong. We saw a 40 billion increase in loans in the week ending April 6th. We saw commercial and industrial loans up. I think I spoke about that in my last video. I find that to be interesting because the last time we saw big increases in commercial and industrial loans, I was reporting that to you, and I said that is an indication of two things. Number one, it was, I think, pointing to some of these supply issues abating and companies stocking up on inventory. And of course, we had that record inventory number in the fourth quarter of 2021. So the C&I loans were forecasting, they were telling us that that was happening. And we're starting to see that again. And I think I mentioned in my last video that this could be related to two things. I think. Number one, it could be related to increased activity In the energy sector, you know, we're seeing rig counts go up now. I think the oil rig count is at the highest level in 25 months. The gas rig count is at the highest level in 31 months. And so that would be a good sign for more output, more petroleum, more oil production, more gas production. It could help stem the price rise. I mean, one of the problems with the ongoing price increases is that we're net exporting our petroleum. I mean, so like, yeah, foreigners are getting the benefit of it, but not Americans. We're paying higher prices for natural gas, higher prices for gasoline than otherwise would have been the case if we didn't have a situation where we were net exporting. But there's also a positive to the net exports, and that is an addition to GDP because it equates to higher final sales of domestic product. You know, inflation is bad because it's a net outflow. I've spoken about this before. It's a net outflow of income. It goes to the foreign sector because, you know, higher import prices. The United States runs gigantic trade deficits, so that's why it's a subtraction from GDP. It goes to foreigners, that income. But at least some of that is mitigated by the fact that we're a net exporter of petroleum. Look, it's not like the 1970s. I've spoken about this before. In the 1970s, the United States was a large net importer of petroleum. Then we had that period in the 70s with 2 oil embargoes where the price of oil quadrupled in a very short period of time. And on top of that, we had the Fed like really jacking up interest rates. And I'm talking about really jacking up interest rates. If you were around back then, you know. I mean, we went from like 4% to 20%. I mean, you know, those are big numbers. I mean, now we're talking about maybe, you know, by next year we'll be at 3.25% on the Fed funds rate. And even that, I'm wondering if that's even possible, because that gets back to something, you know, I made a bunch of videos on this. Can the Fed even do that? Because it has to pay interest on reserves. That comes out of its own money that it earns on its portfolio. You know, so that, to me, that's fascinating, because I want them to go up to like 2.5%, because, you know, that seems like it's going to wipe out all their income, and they're not going to have the income to pay interest on reserves and have the money to fund, you know, their operations. But I guess they can still do it, as I said before, because they could just run with negative cash flow. But what's Congress going to say? I mean, the whole thing is really interesting, and I can't wait till we get to that point. So we got loan. I'll tell you one thing that was a little bit caught my attention in the loan data, and again, this data was through the week ending April 6th. One thing that caught my attention was a drop in consumer loans. It was like the first time we have seen a decline in consumer loans, and I'm talking about credit card and revolving credit and auto loans. It's the first time we've seen a drop in consumer loans in 4 months. Now, auto loans to me are interesting because they always kind of act as like a bellwether for household spending, for personal spending. And they've just been trending up and up and up. And now they're starting to roll over. I mean, I think they're a pretty good indicator of economic activity. It might be a 1-week thing. We'll have to see when the data comes out on Friday, the new data for what would that be, the week ending April 13th. But they are slowing down. I mean, the growth in auto loans are definitely slowing down. But that might also be auto prices not rising as fast, right? I mean, when prices were really accelerating on cars, then loan amounts would be greater, right? I mean, that just makes sense. That's the logic there. So it might be just an indication that we're seeing a slowdown. And I've read some stuff now saying that car prices, particularly used car prices, which have been a major element of the high, you know, CPI numbers that we've been getting every month, I read some stuff where that's starting to slow down. So that would be a good thing. What else is going on? So yeah, we got to keep an eye on the consumer loans. Look, I'm telling you, man, I think I'm the only one out there with a bullish outlook. Again, if you read the commentary, if you read the headlines, everything's going to hell. It's the worst thing that anybody has ever seen. It's the perfect storm of doom and gloom. I mean, you name it. It's just like, it's Armageddon. But if this thing starts going up, I mean, everybody is going to be caught off guard. Not me. I'm going to be sitting here. I'm telling you, folks, I'm going to be sitting here with a bucket of popcorn, just chomping away, having the time of my life. It's going to be like the best entertainment you can possibly imagine. I can't wait, because I think I'm going to be right. Actually, I think I'm going to be right. Fed rate hikes are priced in. I saw something today, some headline saying, hey, we think Powell is close to making a decision on 50 basis points in the May meeting. I'll just tell you right here, they're going 50 basis points. It's already built into futures markets. If one thing we know about Powell, he just follows whatever the market tells him to do. As a matter of fact, you got 50, I'll tell you this right now, you got 50 basis points for the next 3 meetings. That means May. That means June. That means July. The next 3 meetings, you got 50 basis points. After that, it probably drops down to 25 if the market stays the way it is. So, ironically, I would say that a 25 basis point hike in May, that'd be more bearish than a 50. Because everybody would freak out saying, oh, you didn't do 50, you only did 25. Now you're going to have to do, what, 75 or a full point, a full percentage point in the next meeting. I think that would be more of a bearish scenario than a 50. 50 is going to be done. Don't pay attention to headlines saying, oh, he hasn't made up his mind yet. And I think once the Fed makes that move, look, I've been saying we should have like a kind of a choppy market action leading up to the May 4th meeting. And we may even bottom before that. And when the meeting happens, I think that could be like a catalyst for a pretty sharp rally. Because again, everything is built in. And I spoke about the sentiment, market psychology right now is so bearish. I mean, the AAII weekly sentiment survey registered the lowest percentage of bulls in 30 years. 30 years. And that bull-bear spread, that was the most negative ever. And that data that goes all the way back to 1987, that AAII historical data. The latest reading is the most negative ever. All right? So, that sums it up. Hey, folks, it's Monday. I sent out the new issue of MMT Trader. If you want to copy that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial. Anyway, I hope you had a great Easter and Passover. It's back to work now. It's still cold here in New York. Man, I can't wait till it warms up. All right, everybody. See you tomorrow. Bye.